to that conference call with RBI Governor Raghuram Rajan.
Pay attention to some of that also, because many of them, I think, are going to be growth positive.
We'll go over to the questions. From the questions we have received, first one is from Umesh Sharma, Franklin Templeton Mutual Fund. A rather long question. How serious, in your opinion as an economist, is the risk of global deflation? Have we borrowed too much from the future, and with burden having been passed from the private sector to the government, to central banks now, do you feel that financial market risks are underappreciated, or in other words, the easy liquidity being supplied by global central banks is suppressing risk? How do you think all this is going to unravel?
Well, I don't know. I think the hope that number of central bankers have is that they're building a bridge to the future, and that they walk off the bridge fairly easily because the deep ravine or chasm is bridged. My fear has always been that that bridge stops halfway, and we have to exit at a time that we haven't reached the other side, and then we know that there's a deep fall. Time will tell. The muddle-through solution is, economies start picking up somewhat, and the asset price inflation we've had subsides over time, and there are no deep disruptions. That's sort of the best case scenario. Worst case is there are significant bouts of asset price volatility, and we find out who's been playing the markets at that point, and there are consequences. The best case, again, within those is if it's non-bank participants who can absorb the hit. The problem comes if it's levered participants who cannot. So we just have to prepare for volatility.
B part of his question is, with this background, how does an emerging market central bank navigate monetary policy? If he loosens too much, there are asset bubbles, and if policy remains tight, then the economy is at risk of stagnation.
Well, we have a slightly different problem because we still have concerns about inflation. So given the deflationary environment elsewhere, it's actually easier for us because we're not fighting inflation in an environment where inflation is picking up elsewhere. So, I think we're still in conventional monetary policy territory, and so it's easier.
The next question is from Jayesh Kumar, Kotak Securities. New CPI would have higher weight for services, which could indicate much slower disinflationary path than currently indicated. Would you still stay on easing path, or if new CPI brings surprisingly higher inflation or slower disinflation, then could we be on hold for much longer periods?
I think that, it's not apposite to speculate on what the new CPI index number will be. We should wait and watch and analyze the recast. Just as you have written here that it would have higher weight for services, I suspect that it could also have a lower weight for food. So, and the methodology itself is being changed. So I don't think we should speculate on what would happen if the number is a bit larger or a bit lower. And we would do our best to look through these because it's the medium term, short to medium term perspective that is important rather than the immediate reading. So I think it's best not to speculate on this until the numbers come out.
Next question is from Edward Tita, UBS. How do you judge the level of capacity utilization or output gap in the economy, especially in the light of the 2011-12 base year revisions to the national account?
Let me ask Michael Patra to speak on it.
As in the case of the new CPI, it's best probably to wait for the release on February 9th on the new GDP data and then take a view on capacity. But on the existing database, our survey suggests that there is spare capacity. It's about a little above 70%. Also, other indicators of rural demand and consumption demand indicate the slack in the economy.
The next question is from Betsy Kuriakos, Principal MF. What is RBI's view on including trends in unemployment or jobs data for deciding monetary stance? At present, we do not see any data on the same being included in the policy review document.
Well, I think we would include them if we had a good series. We would include them explicitly. Right now, what we do is we have a variety of indicators, including some periodic surveys which we look at. We have some data from large corporations which we also look at. So it's not that it doesn't enter our calculations, it does, but it doesn't necessarily enter our policy statements because we don't have a very precise and frequent series going forward. Urjit, would you like to add anything?
No, just to say that, from what I understand, that we may have a series on quarterly unemployment beginning the second half of this calendar year, and we would look at those numbers and hopefully, they would satisfy standards of methodology, coverage, and quality for them to enter our policy statements explicitly and indeed in our calculations. However, one data series that we do look at fairly closely is the wage growth data, which is an indirect measure of pressure in the labor market.
The next question is from Chamiran Chakraborty, Standard Chartered Bank. Do you think that repeated intermeeting rate decisions undermine the importance of scheduled policy meetings, or are you comfortable with frequent intermeeting policy decisions?
Well, I don't know where repeated came from. We've done it once, so we still have to repeat. Look, I mean, we clearly respect the importance of the dates, the monetary policy dates. They're set in advance, and we would like to adhere to them as far as possible. There are sometimes reasons to move in between policy dates. If nothing else, because of past commitments, that was the reason last time when we committed to move as soon as the data permitted us to move, given that there was, in some quarters, a public perception that the RBI was, tardy. We wanted to say that we understood the need for, action as and when we had the information, and we were prepared to act even outside policy dates. So I think it was useful to signal that. And there might be other occasions when, because of large changes, we feel a need to act. So I don't want to straitjacket us by saying we will never act outside policy dates, but I think the idea behind the question that it's reasonable to act on those dates and not keep doing things outside is a reasonable one, and it certainly is something that we also believe in.
The next question is from Rajiv Radhakrishnan, SBI Mutual Fund. Why has the RBI abruptly stopped issuing of inflation-linked bills? Wouldn't it be desirable to revive the issuance and also make suitable revisions, such as rephasing to CPI, a reasonably liquid IIB issuance, can also provide market-based measures of inflation expectations, etc.?
Let me ask DG Khan to speak on this.
No, as you have said, we had 6 or 7 tranches of institutional IIBs, and we mopped up around 6,000 to 7,000, and after that we stopped. Then we had 3-4 months of retail IIB linked to CPI inflation. We mopped up around 95 crore. After that it has stopped, then we have been in dialogue with government to improve its features to make it more attractive for the retail investors. That is a work in process, and so for the institutional investors also concerned, we have also suggested to government to link it with retail inflation. So we are awaiting the response and the discussions around on that.
Thank you.
The next question is from Arvind Chai, Quantum Advisors. Given that CPI is now the nominal anchor, shouldn't the targeted real rate be the depositor rate for investors instead of the overnight repo rate?
I'll combine the answer to that question and the one by Nirav Dalal from Yes Bank. the targeted real rate is usually the risk-free policy rate. And one reason why that is the case is that that's what the central bank can specify and control. And the other is that it's relevant for the entire economy and not just for depositors, investors, lenders, etc. In that sense, the repo rate fulfills this requirement on these two grounds, and the entire economy is covered then as this is the base, and premium of various sorts, including credit, tenure, term, will then be priced off this. So it's not possible, and indeed it would be incomplete to target a real rate for specific sections of the economy. The risk-free policy rate is the one that should be used, and that's what we do. On the Taylor rule, your question is incorrect. Actually, Taylor himself assumed a 2% real rate for the U.S. In India, where full capacity potential growth or steady state has not yet been reached, as also the fact that productivity differentials exist, that real interest rate accordingly may be somewhat higher given the circumstances, or indeed a little lower. And so 1.5% to 2% that the governor has spoken about seems to be a reasonable number to go by.
Thank you, Jit.
Next question is from Devika Mandirata, ANZ Bank. Could you give some examples of what you consider as steps towards high-quality fiscal consolidation? And two, the month-on-month pace of rise in core CPI ex-transport component has indeed softened. How long do you think that can continue?
Let me take the first one and give Michael the second one. On high-quality fiscal consolidation, I think a movement of spending, for example, from subsidies towards more capital investment, from mistargeted subsidies, I should say. We do need some subsidies. From mistargeted or poorly targeted subsidies to capital investment would be a good move. And good move even from the inflationary perspective, which is the primary reason for us looking at the fiscal, because it will move from current spending without an appropriate supply response to something, current spending, which creates a eventual supply response because of the capital investment being put in the ground. So that would be an example of high-quality spending or high-quality fiscal consolidation. I think more broadly, the entire package is what we're looking at. And let me give the next question to Michael.
Just in the line of what we said earlier, I think it's useful not to speculate and to look at the data that come out in the month ahead, in the days ahead, and then take a view on momentum. Essentially, we communicate in terms of headline inflation, and we watch the momentum of headline inflation very carefully. But to reiterate, it's possibly a better idea to look at the data when they come and analyze them.
There is a related question there. Vinod Harish GS from Wealth Advisor. What is the thought process of RBI behind limiting FPI flows in corporate bonds to residual maturity of 3 years?
I can take that. The question is, why did we limit the residual maturity to 3 years and above? Well, remember, we've already done this for government securities. And to some extent, this is just evening the playing field for the corporate bonds. Initially, we were reluctant because we thought that there would be some benefit to development of corporate bonds if people took more positions in corporate bonds. We could afford to be a little more open. But our sense was there was a number of fairly short-term investors coming in to corporate bonds, especially quasi-government corporate bonds, treating it as near government, and effectively vitiating the reason we put the 3-year limit for government bonds in place in the first place. Now, what are we trying to do here? We're not in any way trying to limit exit, because you can sell your 3-year bond or your 5-year bond and move. What we're trying to do is do a little bit of filtering in who comes in. Some investors are much more reluctant to invest for any term because they fear some price adjustments if in case there's volatility. And these are typically investors who don't want, who are not particularly invested in the country, but are taking fairly short-term positions. We believe that those who come in at the longer end are taking a more careful sort of view of the country, or spending more time analyzing before they come in, and therefore are likely to stay longer. This certainly was our experience with investors in the turmoil in summer of 2013, and taking the lessons from that, we're basically saying we love to have you, just stay a little longer.
The next question is from Jyotinder Kaur, HDFC Bank. Given that the RBI expects inflation to be close to its target of 6.3% and the existence of a negative output gap, how would you explain the fact that the RBI wants to limit easing to the neutral rate, that is 1.5 to 2.0, and not below it? This has reference to your statement to media yesterday about real policy rate of 1.5 to 2%.
I guess this is a difference between statics and dynamics. Is the output gaps narrowing because of forces in play already? And to that extent, do we need to add additional momentum to it? And our sense is it's narrowing. Our estimate for next year, 6.5% growth, with only moderate help from monetary easing. So my sense is that the output gap is closing for a variety of reasons, including the alleviation of supply constraints that were in place that the government is taking actions on. And so to that extent, it's more of a dynamic issue rather than a static issue.
Her next question is, the RBI, like many other central banks across the world, has conditioned its guidance on incoming data. However, given the backward-looking nature of this data and the lags associated with monetary policy transmission, does the central bank not run the risk of falling behind the monetary policy reaction curve? If so, is this risk more than offset by the reassurance provided by this data?
Let me ask Dr. Urjit Patel to speak on this.
Incoming data is immediately passed and analyzed, and they become inputs for our forecasts. And the forecasts are forward-looking, taking into a variety internal technical models and judgment. And therefore, and only subsequently are these used as intermediate targets to conduct forward-looking monetary policy. And therefore, I think the work that we put behind this in terms of analysis and segmentation, momentum indicators, and internal models which have forward-looking variables built into them gives us some reassurance that they are not backward-looking. And also, we do take the input of our forward-looking inflationary expectation service from the households and the forecasters, professional forecasters, etc. So I think we have a reasonably good balance in terms of the data that we look at when making these decisions.
Next question is from Alok Sahu, Baroda Pioneer Mutual Fund Bank. How do you see the impact of revised GDP number in monetary policy action, with the new number suggesting a strong recovery in the economy?
Well, as I said yesterday, we're still trying to understand it. So we need to see the February 9th releases as well as the end February releases on the details before we come to strong conclusions about this. I would say something I said in a different interview today, that is, we may be reaching the outskirts of the woods, but we're not out of the woods yet. So I don't think any data that suggests we're out of the woods at this point we would take we would put over too much weight on it.
The next question is from Ravikant Rathod, Tata Asset Management Limited. Large-scale quantitative easing by both ECB and Bank of Japan. Can we expect there is room for depreciation of rupee going ahead?
Well, if there is large-scale easing by systemic central banks, in fact, the pressure on emerging market currencies is opposite to what you have postulated. And as you know, we don't directly comment on which way the rupee is going to move, except that we don't like volatility and we intervene accordingly, and only for that reason rather than any target in mind, regardless of what other central banks do.
The next question is from Amit Agrawal, Societe Generale. What would be the RBI's preferred liquidity management tool if the foreign flows continue to pour in India, given a stable current account profile? Please elaborate in terms of OMO buyback, CRR, sterilization bonds, short-term repos.
Let me ask Urjit again to answer that question.
A sort of soft rule of thumb that we use, and it's not ingrained in stone, is that in terms of what we perceive to be permanent injection, we use sterilization instruments that are permanent in nature. For example, OMO is preferred, but eventually we make a judgment call and we use a variety of instruments suitable for the time. But broadly, permanent is addressed through OMOs, and for short-term issues we use the other instruments, except I wouldn't say the CRR would be used. I mean, that's an extremely rare instrument for this purpose, and sterilization bonds only enter the picture when we don't have enough instruments on our balance sheet.
Let me add something to what Urjit said, which is that the world has become friendlier to counter-cyclical prudential policy when it comes to flows, and one of the actions we took yesterday should be seen as part of that, which is we liberalized outflows. The LRS, which is the liberalized remittance scheme, we took up from 125 to 250, beyond where it was when we curtailed it in September of 2013. Remember, at that time there was a hue and cry about us curtailing an existing outflow, but that was a macro-prudential measure. This is again a macro-prudential measure, and while we don't expect this to be high frequency, so that people have time to make considered investment decisions, we retain the right to get more liberal or get less liberal over time, depending on the macro-prudential needs of the economy.
Shall we take a few questions from live? Shaina, can you announce?
Sure. Participants connected to the audio call, if you wish to ask a question, please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. We have the first question from the line of Sriram Ramanathan from L&T Mutual Fund. Please go ahead.
Hello, Governor. Basically, just two quick questions. First is if there is any update in terms of the inflation targeting framework that's being discussed with the government, and whether any kind of progress has been made on that. The second one, I think it's been covered in a few ways, but just a particular aspect of that, given this whole easing of financial conditions across the world by almost every other country to the extent possible, both on the interest rates to the maximum extent possible and on the currency side, once again to the maximum extent possible. Over here, we are kind of constrained on the currency side, given limited weakness that is possible. So is there an additional element that gets introduced on the interest rate side, more in terms of cyclicality of the real interest rate as well? Because yes, this 1.5 to 2% clearly is a big issue. So is there an element of cyclicality that comes in for real interest rates in this context? Because that's a limited action that we can do over here on the financial condition side.
On the framework, it's currently being discussed. Yes, there has been progress, but I don't want to give repeated bulletins on the state of the discussions. My hope is that when they conclude, we can put out the entire framework at that point, but progress has been made. On the second issue, which is, I guess it's a question about the real interest rate over the cycle, and our judgment of 1.5 to 2% is, given that we are closer to the bottom of the cycle in India than the top, this is the kind of rate which might energize investment. Of course, to those who say it should be zero, well, that's peculiar to the industrial countries at this point, given where they are. Remember, we have to also incentivize savings, and we can't run the risk of another bout of large current account deficits and instability as a result. So keeping that in mind, I think we are comfortable with the 1.5 to 2 range at this stage of the cycle, which means that as the cycle progresses and gets stronger, maybe the equilibrium real rate might increase a little from that. But certainly at this point of near at the bottom of the cycle, keeping in view the need to incentivize inflation, it would be 1.5 to 2, and I think it will stay this way for some time.
Next question.
Thank you. The next question is from the line of Nikhil Gupta from MK Global. Please go ahead.
Yes. Hello, Governor and the team. Okay, my question is related to a subject which for some reasons I believe is not widely debated, at least publicly. This is about savings in India, which you just spoke about, Governor, but I would like to continue to start with some data first. Now, household savings in India have fallen from almost 25% in FY10 and 23% in FY12 to 18% last year, according to new data released. And we cannot expect to increase investment in a sustainable manner unless we have it financed domestically through savings. Now, considering the cuts that commercial banks have done in the deposit rates, what do you think needs to be done in order to boost savings? I mean, do you think we have reached the bottom on this front? Or if not, then what can the monetary authority and the government do to have savings? I have a second question also. I'll ask it later, please.
Well, I think we have crossed the first hurdle, which is moved away from negative real interest rates to positive real interest rates. And that is important to reward the saver. And I welcome your question, because too many people focus only on the producer side and not on the savings side. And we need to keep that in mind. But the other aspect is whether there could be some tax benefits to savings. Remember, the government increased the limits for tax benefited savings by about by 550,000 rupees in the last budget. And the question is there room for more? Primarily because the real tax benefit has fallen over time, because that limit was at 1 lakh for a long time. So maybe what we have to do is increase that. Final point, that one should not diminish the role played by lower inflation in increasing real disposable incomes, and thereby giving people more of an ability to spend. I think that has also more of an ability to spend, but also to save. And I think that could also play a part in savings. Finally, the shift between real assets and financial assets will also play a part as financial assets become more attractive.
Okay, thank you. My second question is, according to Dr. Ujit Patel's report, our medium-term inflation target is 4% plus minus 2%. Now, currently we are at 5 to 5.5% target. I mean, we have had an average inflation of almost 9.5% in the past 7 years. So if we go by the inflation index, we have had huge inflation in the past few years. So wouldn't it be nice to have a lower than target inflation for some time before trying to boost the demand? I mean, in simple terms, what I'm trying to say is, wouldn't it be wise if we see an inflation of lower than 4%, somewhere around 2 to 3%, to be sure that, okay, we have reached short disinflationary trend, and probably 4% is within our reach?
Let me ask Gurjit to respond.
Firstly, I think a sort of intertemporal substitution of inflation rates is not a valid economic policy making metric. But on a more serious note, I think given where we are in the development cycle, if we were to try to get inflation below 4%, firstly the basis of anything below 4% needs to be established. Assuming that there is, we run a risk of deflation actually, and given our development needs and the need for further growth, and 4% has been reached, or rather recommended, that advanced economies are at about 2%, and we have a productivity differential of about 2% on average, and that's one of the primary bases on which the 4% has been reached. So I think that's a defensible target with a range of plus or minus 2. And I don't think we need to revisit that because we have had higher inflation in the past few years.